last video, we talked about preferred stock and the different features of preferred stock and kind of what it is. And again, preferred stock is purchased for income, for the dividends that it pays. And in this case now, in this video now, we're talking about how to value preferred stock. And just like we did with bonds, we're talking about finding the intrinsic value of the preferred stock. What's it really worth? What's the most I'm willing to pay for it? Now, the formula for it's relatively simple. The intrinsic value of a share of preferred stock is the annual dividend on the preferred stock divided by your required return on the preferred stock. Now, let's take dividends first here. Now, dividends on preferred stock, of course, are important to investors. And as an investor, you should understand that preferred stock dividends are expressed in two ways. One is a dollar format. That is, they'll tell you this is a $7 preferred stock. What they mean by that is that if you buy this preferred stock, you'll get $7 a year forever. Okay, now they're paid quarterly, but the cumulative dividend over the course of the year will be $7. The other format now is in a percentage format. They'll tell you, this is a 7% preferred stock. Now what they mean by that is that if you go to the balance sheet, find the par value of the preferred stock, okay? If you find the par value of the preferred and multiply it by the percentage, that'll give you the dividend. So if this is a 7% preferred stock and the par value is $100, then your annual dividend is $7. Par value technically can be anything. If the par value had been $50, 50 times 7% is $3.50. So again, don't assume that par value is $100. It could technically be anything, and you need to make sure what that is. The other thing about par value with preferred stock, in bankruptcy, preferred stockholders make claims on assets before the common stockholders do. If I own 10 shares of this preferred stock, in bankruptcy, when they got to me and the judge asked me what my claim was on the assets of the company, my claim would be the cumulative par value of my preferred stock. So if I own 10 shares, I would tell the judge that my claim is $1,000. So the par value on preferred stock now is used for two different things. One is to define the annual dividend the preferred stock pays, and the other is to define your claim in bankruptcy. So again, go to a balance sheet of the company, find out what the par value of the preferred stock is. That's what you should do. Now the denominator here, now this is our required return, which we talked about with bonds too a little bit. But required return now, K, is what is used commonly in finance to define required return. At any rate, K is required return. This is our minimum acceptable return on the investment. We don't want to have any return less than that number, whatever that is. The way you calculate required return for a company on a stock and an investment now, commonly used the capital asset pricing model, the CAPM, the capital asset pricing model. And we're going to talk more about that when we get into the common stock videos, but CAPM, that stands for Capital Asset Pricing Model, developed by a man named William Sharp in the early 60s. Just to give you a little example here, if we had a $7 preferred stock, paid $7 a year in dividends, and our required return were 12%, the decimal equivalent 12%, 0.12. 7 divided by 0.12, $58.33. $58.33 would be the intrinsic value of this preferred. How do you interpret that? Well, if you looked up the price of the stock in the market, and the price of the stock in the market was $65 a share, would you buy the stock? No. The stock is overvalued in the market. If you paid $65 for this preferred stock, you get a return, but it'd be less than 12%. If I could buy this stock for $55, would I buy it? Answer is yes, because it's undervalued in the market. And indeed, if I paid $55 for this stock, I would get a return that would be greater than 12%. You're a total return investor. What your required return is now, in this case 12%, that's your minimum acceptable return. You never want to buy any asset that gives you a return less than that.